Have you ever taken a look at your mortgage payment and you notice a line that says mortgage insurance or PMI, and you're wondering, what is this couple $100 a month I'm paying for? Hi, everyone. If we haven't met yet, my name's Troy Sage, your real estate insider and your host of Real Estate Talk. And on this episode, we're going to discuss mortgage insurance, what it is, and how to get rid of it. What's up, Chris?
Hey man,
It's
happy ice week.
Yeah, man, it's been really cold here in the Dallas area. Like I've been in the house for a while. Listen, the questions that come about from clients that have homes or that are buying homes, one question that we haven't talked about is mortgage insurance. So, what
Yeah.
is mortgage insurance, man?
So mortgage insurance is it is the one thing that you have to have if you put less than 20% down on normally on a conventional loan. And nowadays, right, a lot of people have this misconception that you have to put 20% down. Well, it all started with, mortgages were becoming more and more popular back in the 60s, 70s, 80s. There was essentially no lenders that were financing more than 80%, right? So they wanted you to put that big chunk down. Well, of course, since then, government regulations and all this stuff that has come in now allows buyers to be able to purchase with less money down, but you have to have either PMI, which is private mortgage insurance, on government loans. So FHA, USDA, it's like MIP, which is mortgage insurance premium. So it's essentially the same. It's the same thing. They just call it something a little bit different. But what it does is it protects the lender in the event that you default, and that's basically it. So now, right, fast forward 2023, you can purchase a home as a first-time home buyer with as little as 3% down on a conventional loan, 3.5% down on an FHA loan, and of course on USDA you can do 100% financing. But all of those options are going to have some kind of mortgage insurance, whether it's private or MIP through, essentially subsidized through the government.
So if I'm buying a home today and I don't have the 20% down, the average sales price over $500,000 in the Frisco area, I don't have $100,000 to put down. I can still get a loan. It's
Yeah.
just that I'm going to have an added expense in my monthly payment.
Yeah. So yeah, on a $500,000 purchase, you can put, 5% down. Let's just say for conventional, again, for first time home buyers, you can do a little bit less, but traditionally it's 5% down, right? And assuming pretty good credit, your mortgage insurance premium per month is going to be on top of property taxes and home insurance.
That's really good to know. And on a side note, or added to what you just said, mortgage insurance is different than hazard insurance. And I think that's been a misconception by some people. They say, oh, I have mortgage insurance. Well, they still have to have their dwelling insured, not only for themselves, but
That's
also
right.
for the lender. The lender's not going to let someone move into a home and not have the dwelling insured in the event of
Protected.
something that happens, like a fire or a tornado or something.
Yeah, absolutely right. Financing a home and you're doing less than 20% down, you will have both private mortgage insurance of some kind, or not or but and home insurance, right?
If I'm going to put 5% down, conventional, you had mentioned just a minute ago, what is my mortgage insurance going to run? Is it a percentage of the amount borrowed, or is there a static amount that every month is going to be on there? How does that work?
Yeah, so it's a percentage of your loan amount over a year, and then of course divided by 12 months. So it is credit score related, right? So the higher the credit score, the lower that amount per month will be. So it is a percentage based, and it is tied to your credit score, and that is kind of the difference, right? And we're jumping, between programs, but that's the difference between like a conventional loan and FHA, where FHA has a set amount, right? It's 0.85% per year. If you do less than 5% down. So if you do 4.99 to 3.5% down, which is the minimum, it will be 0.85% per year. And of course, that's then divided by 12 months. If you do 5% down or more, then it decreases to 0.8% per year divided by 12 months. So
All right.
that is kind of the biggest differences between FHA and conventional, where FHA, the amounts are fixed, and conventional, they're based on credit score.
And it's less than 1%, because I did have a client say to me, oh my gosh, on a $400,000 loan, my mortgage insurance is going to be, $20,000. And I'm like, it's not going to be that much money. It's less than 1%. So that's good to know. And I know it's ballparked. And good to know also, I didn't know this, that it's predicated, except for FHA on a conventional note, it's predicated by your credit. So just another reason for people to really pay attention to their credit before they purchase a home.
Yeah, I mean, you bring up a great point. You have to, be monitoring your credit, especially if you're looking to purchase a home or even refinance. Because, a lot of people purchase a home and then they don't pay as much attention. Well, a bill slips through here, slips through there. Now they've got, a couple late payments and their credit score's been torpedoed. So it's something that you always have to monitor and look at.
It's so important to establish a solid game plan when you're buying or selling real estate, because of the fact that there's so much predicated by your credit score.
Yeah, I mean, it's really what um from a mortgage perspective, what it all comes down to from a cost standpoint. It's all based on credit. So
And what a lot of people forget, I know we're sidebarring just a little bit, but what they forget in this journey of buying or selling real estate, it's an asset. So the reason the banks have a mortgage insurance in place, of whether it's PMI or MI, is they want to ensure that the asset that they're investing in with you is covered. If something goes wrong, the bank isn't going to
sure.
lose. And that's why you also have hazard insurance, that if something goes wrong, you as a homeowner aren't going to lose. So let's fast forward. Let's say I've been in a home for a couple of years. How do, if someone buys a home and they have mortgage insurance on their loan, how does that go away, or is it there forever?
So yeah, so we'll start with conventional, right? So you purchased a home 5 or 6 years ago. You have a conventional loan. Um, Obviously, what the home is worth now is probably significantly more than it was when you bought it. It will the PMI on a conventional loan will fall off automatically once you reach 78% loan to value. Someone that purchased a $500,000 home, 5 years ago, let's say it's worth $600,000 now. Well, 80% of 600, right? They've probably already reached that number as far as their loan balance goes. So all they would need to do is pick up the phone, call their servicer, and say, "Hey, I would like to pay for an appraisal or an appraisal to confirm what my current value is, so that I can have the PMI removed." Now, if you just bought it a year ago or 2 years ago, you'll have to again contact your servicer to find out what their specific requirements are, because they may require you to make 12 mortgage payments, or even up to 24 mortgage payments before they'll reassess. Now, the last couple of years, we probably haven't had the increase in equity that we did, over a 4 or 5 year period, but it's still worth looking at. If you were on the fence, right? If a couple years ago you bought and you put maybe 10% down or 15% down, you may be close to where you can have that PMI removed, specifically for conventional financing, right?
And it
So then
has to do
jumping
with
over to,
and it has to do with
go ahead.
the actual value of the property today. So I
Right.
think your point is, listen, if you bought 4 or 5 years ago and you bought for $500,000, and you're seeing that the homes in the neighborhood are selling for 600, 650, 700. I mean, shoot, there's some
Yeah.
neighborhoods I've sold homes to people for 500 and they're worth 8 or 900,000 today, which is
Right.
it's just rare, but it does
Right.
happen. It's a
Yeah.
simple phone call to their bank, or as you said, to the service or whoever they're making their payment to. They pay for an appraisal, and if it comes back that they've got 20% equity in the property, then
That's
they'll
right.
just remove it, and it'll drop they'll drop the insurance.
Yeah. And then it obviously lowers their monthly payment, because
So
that
okay,
that part's going away.
so you touched on conventional. What about the FHA buyers? Is that's a
Yeah.
different game, right?
Yeah, it is a whole different game, right? So, FHA specifically and USDA, so they both have mortgage insurance, right? A mortgage insurance premium or of some kind. Those are on there for the life of the loan. So that's, again, all of my buyers that I talk to, doing FHA financing. Hey, this is a kind of a short-term path to get into the home with minimal out of pocket, right? But we're going to want to watch the market over the next 3 to 5 years. And now, right now that appreciation is kind of slowed down, it's probably going to be a little bit longer. but we're still going to continue to monitor to see when, when you have that 20% equity position, and then you'll need to refinance out of that FHA or USDA loan into conventional financing to then not have PMI or mortgage insurance. It's a
So
little bit different.
yeah, so the bottom line is anyone that bought, say, let's say 3 years ago, right? And say that they bought a home for $400,000 and today it's worth $500,000, right?
Yeah,
It's in their best interest to keep an eye on the interest rates or stay in touch with you to say,
absolutely.
hey, not only has the home appreciated, but I've made enough payments to where I only owe X amount of dollars. I have about 20% equity. Then
Yep.
it's to refinance. And one of the challenges we're having in the market today is you'd have to figure out the numbers to go, okay, well, where the rates are today compared to where you were 2 years ago, it may or may not change your mortgage payment much at all.
Again, that's why you want to, we'll walk through the numbers, right? So I have customers that are calling me that purchased 4 or 5 years ago, and when, a month ago or so, when rates were just barely coming off the set, the 7.5% highs, we were basically, I was telling them, hey, we probably need to hold off, right? It feels like interest rates will continue to keep, headed down, not overnight, not in a straight line, but interest rates will be lower in the future, right? 6 months, 12 months out. So let's hold off. Let's watch the market, because again, in their particular situation, their payment was actually going to go up because of the difference in rate, right? They were at a 3% rate on their FHA loan. Going up to 7 or 7.5 is it defeats the whole purpose of even eliminating that, the MIP on FHA. It's just, it doesn't make a whole lot of sense, right? So that's what we really want to, let's look at the numbers. Let's look at principal and interest on your current conventional loan. Let's look at principal and interest on the new one, and kind of evaluate those options.
That's great information, man. So if anyone's watching the video and you're wondering, like, where's my equity today? Or should I get rid of my mortgage insurance? There's a link in the description below. You can reach out to me or to Chris, and we'll run the numbers for you. And whatever's best for the homeowner, obviously, if we can save them a little bit of money, but then by all means, let's save them a little bit of money. But
Right.
you really got to look at where you bought, where your mortgage payment is at today. And there's a whole other episodes where we'll talk about how to pay off a loan faster, how to reduce your principal, et cetera, et cetera. But man, awesome,
Right.
awesome information. I really appreciate you, Chris. Let's see what we can do to help as many people as possible, and stay warm because it is cold
Yes,
here in Dallas. I mean, my roads are.
for sure. Hey, it's warming up though. Great news, it's warming up, right? And back to kind of what you were saying, it's super important to, obviously work with someone that you know or trust, because at the end of the day, I'm not going to sell somebody a refinance if it doesn't make sense, right? And that's what we know. Again, I am probably about 99.9% sure that rates will be lower in the next, 6 to 8 months. So I'm not going to refinance somebody now, knowing that I'm going to have to refinance them again in 6 months, right? It's if there's nothing catastrophic, if you don't need to save however much per month, let's wait, right? And that's where, again, we always put the customer first, and their needs, as if it was being done to us, right? I mean, that's how we operate. So
I appreciate you saying that because I just did a whole thing, a whole presentation to some real estate agents. And I said, the key thing in being successful in the lending industry and in the real estate industry as agents is showing people the truth of what's really going on. And if it's not in their best interest to do something, is be an adult and say, look, man, this might not be the best time for you. If we build a business via integrity and help as many people as we can, then we always have that longevity. I mean, even Warren Buffett
yeah,
has talked about businesses that if the foundation isn't strong, the building will fall. I don't know. Hearing that from
yeah.
a guy that makes a couple dollars a day uh, is
At
exciting.
least two, at least
Yeah.
two,
So
maybe a second, $2 a second, call
yeah.
it a
So
second.
always good talking to you, man. Let's do this again. And
Yeah, thanks for having me, for
let's
sure.
keep people informed. If you have any questions about real estate or home loans, feel free to leave a comment below. We'll be happy to answer your questions, or you can always reach out to us direct. Again, this is Troy Sage. Do us a favor, click the like button if you like this video. Click subscribe if you'd like to stay current on all things real estate. And as always, my friends, make it a great day.